appropriate places we were talking about various kinds of penalties. Now specific penalty, which is section 270A, very specific, only in relation to misreporting or underreporting of income during the course of assessment or reassessment or revision. The total income of the assessee increases or the loss of the assessee decreases. That means there is an underreporting of income that has happened. Underreporting of income that has happened, or it could be a misreporting of income for which we have to compute the penalty under section 270A. Penalty under section 270A. It could be levied either by the assessing officer during the course of assessment or reassessment proceedings, or it could be levied by CITA during the course of appellate proceedings, or it could be levied by CIT during the course of revisionary proceedings, 263, which we discussed. During the course of revisionary proceedings, it could be levied by the CIT. So CIT or CITA or assessing officer can levy this penalty. How much penalty? Under what circumstances? How do we compute penalty? We are going to discuss that. The first one that we need to understand is what is the cases of underreporting of penalty. The cases of underreporting of penalty, when it would be applicable. Now, underreporting of penalty, first circumstance, that is, return of income is filed. The assessee has filed the return of income and assessment is made for the first time. Assessee has filed the return of income and assessment is made for the first time. This assessment can be 143.3 or it can also be 147 assessment, but it is made for the first time. Recollect our discussion, friends. You can have 147 also as the first time of assessment. That also can be the first time where you can do the assessment. So return of income is filed and the assessment is done for the first time. In that case, underreporting of income will be equal to income assessed minus the income determined as per section 143.1. Income determined as per section 143.1. This would be considered as underreporting of income. Next, second case, return of income is not filed. Return of income is not filed and assessment has been completed under section 144, 144 or 148. If return of income is not filed, then 147 assessment is not possible. 147 assessment is not possible if return of income is not filed. 147 assessment is 143.3, sorry, 143.3 assessment is not possible. It has to be only under section 144. It has to be only under section 144. Now, let's go ahead. Understand how do we need to compute in this case. The way that we have to do is again, under reporting of income would be equal to income assessed minus basic exemption. Minus basic exemption. In case there are no basic exemption, in case there are no basic exemption, then that is in case of individual we will have basic exemption. In case of company, AOP, BOI and all, BOI sometimes there are basic exemption, partnership firm, then this should be zero. Then this should be zero. Right? Now, next, third, income reassessed. Income reassessed. In that case, under reporting of income would be equal to reassessed income minus income assessed in the earlier order. In the earlier order, let's say 147 assessment has been done now. Earlier already 143.3 assessment has been completed. Earlier already 143.3 assessment has been completed. Now 147 assessment is done. So what you need to do? Take up whatever is the income that is assessed as per 147 minus whatever has been assessed under section 143.3. Whatever assessed under section 143.3. Right? So income assessed under section 143.3 would be reduced from income that you have got under section 147. Then next, fourth scenario. Fourth scenario. Return of income is furnished. Assessment is made. And section 115 JB or 115 JC is applicable. MAT or alternate minimum tax is applicable. MAT or alternate minimum tax is applicable. MAT or alternate minimum tax is applicable. Underreporting of income would be equal to additions made under the normal provisions plus additions made under MAT or AMT. Both have to be taken into consideration. Both have to be taken into consideration. Additions made. Additions made under the normal provisions plus the additions made under MAT, both have to be considered. However, if there is a common addition that is made under both normal provisions as well as MAT, then you will not consider that under MAT. Where there is an underreporting is considered under the normal provisions as well as under MAT, such item should not be considered under MAT. Such item should not be considered under MAT provisions. Underreporting of income would be therefore additions made under the normal provisions plus additions made under MAT or AMT. However, the common addition should be taken only once, should not be taken twice. Fifth case. In case of loss return, it is not return of income, it is return of losses. Underreporting of income will be equal to, underreporting of income would be equal to loss assessed minus loss as per the return of income. That means what we need to do is, as per the return of income, the loss is, let's say, 10 lakhs. As per the assessment order, loss is, let's say, 3 lakhs. So loss has reduced by 7 lakhs. That would be considered as underreporting of income. That would be considered as underreporting of income. Sometimes loss can convert into income also during the assessment. Let's say it got 2 lakhs as income. Then underreporting of income would be 12 lakhs. 10 lakhs of loss became 2 lakhs of income. How much additions have been made? 12 lakhs addition has been made. That would be considered as, that 12 lakhs will be considered as underreporting of income. Moving to the next one. So these are the 5 cases of underreporting of income. Now, after you calculate the underreporting of income, the penalty would be like this. Penalty would be like this. If it is underreporting of, if it is misreporting, penalty would be 200% of tax on underreporting. 200% of tax on underreporting. If it is others, then it is 50% of tax on underreporting. If it is not a misreporting of income, then it would be 50% of tax on underreporting of income. So what we need to understand therefore now is to concentrate on what do we mean by misreporting of income and what do we mean by tax on underreporting. What do we mean by tax on underreporting? We have to understand misreporting of income and tax on underreporting. So we have been discussing what do we mean by underreporting. Now penalty is based on tax on underreporting. So first, let's understand how do we need to compute tax on underreporting of income. How do we need to compute the tax on underreporting of income? If return of income is not filed, assessment is done for the first time. Assessment is done for the first time. Then tax would be, we have already found out what do we mean by underreporting of income. Now tax would be tax on underreporting of income plus basic exemption. So you will add underreporting of income and basic exemption. On that find the tax. On that find the tax. That would be considered as underreporting of the tax on underreporting. In case of loss return, tax on underreported income. Find out underreported income. We have already found out the underreported income. On that compute the taxes. On that compute the taxes. In case assessment is done, second time, third time, or any other case, in any other case, it would be tax on underreported income plus income as per the preceding order. So we will add the income as per the preceding order and underreported income. On that calculate the tax minus tax on preceding order. Minus the tax on preceding order. Now, let's go ahead. Understand every case with an example here. If it is assessed for the first time, return of income is filed, underreporting of income would be, as per your 143(1), the income is 30 lakhs. As per income assessed is 50 lakhs. So 20 lakhs would be considered as underreporting of income. 20 lakhs should be considered as under reporting of income. So it is income assessed minus income as per 143.1. 20 lakhs should be as income as per under reporting of income. If return of income is not at all filed, then as per income assessed, let's say it is 40 lakhs minus basic exemption of 2.5 lakhs. So 37.5 lakhs will be considered as under reporting of income. 37.5 lakhs will be considered as under reporting of income. Next, now in this case, let's say the income assessed under section 141 reassessed. It is let's say 75 lakhs. Already it was assessed for how much in our given example? 50 lakhs. So 75 lakhs minus 50 lakhs, you will have 25 lakhs as under reporting of income. 75 lakhs is the reassessed income minus as per the earlier order is 50 lakhs. 25 lakhs should be considered as under reporting of income. Now, so how do we calculate tax on under reporting of income? Return of income is not filed first for the first time. That means in our given case, under reporting of income which is 40 minus 2.5 lakhs will be 37.5 lakhs. So how do we need to compute? 37.5 lakh is under reporting of income. To that add basic exemption. On 40 lakhs compute the taxes. On 40 lakhs compute the taxes. So how do you compute? Individual, you will go by slab rates on 40 lakhs, whatever is the taxes, that would be considered as tax on under reporting of income. Now, here, as per my return of income, it was 10 lakhs loss. As per the assessment, it is 7 lakhs. So under reporting of income is 7 lakhs. So in case it is a loss, you have to find out tax on 7 lakhs. You have to find out the tax on 7 lakhs. That would be considered as tax. And if it is misreporting, 2 times this. If it is under report, if it is other case, it is divided by 2. Then in any other case, let's say we will take up this particular case where it was 75 lakhs as per the reassessed income, as per the earlier order 50 lakhs. Therefore, under reporting became 25 lakhs. So we have got under reporting is 25 lakhs plus income as per the previous assessed is 50 lakhs. So you have to find out tax on 75 lakhs minus whatever you have already got as the order tax on 50 lakhs. Earlier order it would have been 50 lakhs. On that whatever you have got, that would be considered. Hope you are able to understand this discussion. Right. Moving on to the following scenarios are called as misreporting of income. Following scenarios would be misreporting of income. That means you will find out tax on underreporting, multiply by 2. Tax on underreporting and then multiply by 2. First, suppression of fact. Suppression of, you have got a fact which you have not actually correct, but you have suppressed the fact. You have suppressed the fact. Next, falsification of injuries. That means you know for sure you have purchased an asset only by way of cash. The asset value is 50,000, but we purposefully say purchased by way of account payee check. Because you want to claim depreciation, false entries have been passed in the books of accounts. False entries have been passed in the books of accounts. Third scenario, that you made an investment, that investment was not recorded in the books of accounts. You made an investment, but that investment was not recorded in the books of accounts. Fourth, the assessee has claimed an expenditure without any evidence. Just passed an entry saying that rent paid, but actually rent has not been paid. Claiming of expenditure without any evidence. Failure to report international or specified domestic transaction under transfer pricing. Failure to report international transaction or domestic transfer pricing will be considered as misreporting of income. Twice the penalty would be. Now the assessee received some income. That income was not recorded. Income not recorded in the books of accounts. Income not recorded. That means there is an intention to do fraud. There is an intention to do fraud. If that intention exists, then it would be considered as misrepresentation. Will be considered as misrepresentation. Right? These are the cases of. So first thing is to find out underreporting of income. After you find out the underreporting of income, you have to then find out the tax on underreported of income. Tax on underreporting of income. After you find out the taxes, you have to find out whether it is a misreporting or whether it is an underreporting. Misreporting would be twice, underreporting would be once. Would be divided by 2. It would be divided by 2. Now, before we proceed to understand further under section 270A, let's go ahead appreciate. Let's go ahead appreciate one more. We will do one problem first, so that we will see how best we have understood. Now let's go ahead. It says XYZ is a firm liable for tax at the rate of 30%. The following particulars are furnished as per the return of income, as per 143(1), as per assessment, as per reassessment. Can a penalty be levied under section 270A? If the penalty can be levied, what is the quantum of the penalty? That is what the question is all about. Now let's go ahead and do this particular working. Hope you are able to see my Excel. First, these are all different steps. First 143(1) got, then 143(3), then we have got 147. So there were different steps that were involved in doing this. So let's go ahead. In the first case, at the time of under income assessed under section 143(3), income assessed under section 143(3), under reporting of income would be equal to, income as per the assessment, assessed income minus 143(1) income, which is 75 lakhs minus 60 lakhs. 75 lakhs minus 60 lakhs will be 15 lakhs. Under reporting of income would be 75 lakhs minus 60 lakhs. How did you get that 75 lakhs? That is the income that is assessed minus 143(1). So under reporting of income is 15 lakhs. Now tax on under reporting of income. Tax on under reporting of income. It will fall into the third category. So let's go ahead. What is third category? How do you find out? The tax on under reporting of income? It is tax on under reporting of income. Tax on under reporting of income minus income as per the preceding order. Tax on under reporting of income plus income as per the preceding order minus it will be tax as per the preceding order. So let's go ahead. First, you have to this leg will be 15 lakhs plus 60 lakhs. So it would be tax on 75 lakhs. That is 30% on 75 lakhs. Why are we getting 30%? Because it is a partnership firm. So it will be 75 lakhs into 30%. You will have 22 lakh 50,000. You have to also add cess to this into 1.04. Cess 4% cess should be considered, which will give you 23 lakh 40,000 rupees. So this would be the first option. Now the first limb. The second would be tax as per preceding order. What is preceding order? 143(1). That is 30% on 60 lakhs. 30% on 60 lakhs. So it is 60 lakhs into 30% into 1.04. What the 1.04 is? Education cess. 1.04 is education cess. So tax on under reporting of income. Tax on under reporting of income would be 23 lakh 50,000 40,000 minus 18 lakh 72,000 minus 18 lakh 72,000. You will have 4 lakh 68,000. What is the problem? So if it is misreporting, it is 4 lakh 68 into 2. If it is others, 4 lakh 68,000 divided by 2. Hope you are able to understand this discussion. Next, income assessed under section 147, not for the first time. So under reporting of income would be equal to reassessed income minus assessed income. Reassessed income minus assessed income. Reassessed income is 95 lakhs minus 75 lakhs, which would be 25 lakhs, 95 lakhs. The 95 lakhs minus 75 lakhs, which would be 20 lakhs. Which would be 20 lakhs. Here again, tax on under reporting of income, you have got three. One is return of income not filed. Second is for the loss. Third one is others. Here also you have to do only like this. Tax on under reporting of income minus tax as per the preceding order. So tax on under reporting of income plus proceeding. So it will be tax on what is under reporting of income 20 lakhs plus income as per the preceding order is 75 lakhs. So it will be tax on 95 lakhs, which is 30% on 95 lakhs. 30% on 95 lakhs. Again multiply by 1.04. What is that 1.04? That is the CIS. That is the CIS. From here, it would be tax as per preceding order. We have already calculated the tax as per the what is the earlier order? 23 lakh 40,000. That should be taken. So now tax on under reporting of income would be 29 lakh 64,000 minus 23 lakhs 40,000. So 6 lakh 24,000 will be considered as tax on under reporting of income. If it is misreporting, multiply by 2. If it is any other case, it is divided by 2. Now you have to let me know if at all you have got doubts. Otherwise, you have got one more problem where we will do that problem. Right. Let's go to problem number 2. Please go ahead, do this. Then again, we'll discuss. You can take up 10 minutes of time. Please do this and then we will discuss. Says, what would be the penalty leviable in case of the following assessees? There are two assessees that we have got. If none of the additions or disallowances were made under 270A6, that is, it's not a misreporting. And the underreporting is not on account of misreporting. We have got for alpha, we have got for beta limited. We have got for alpha, we have got for beta limited. Alpha, maybe we can say LLP. Beta limited is a trading company. The total turnover for the earlier year, that is 1920, is 401 crores. To tell you that the tax is at the rate of 30%. To tell you that the tax will be at the rate of 30%. Right. Let's go ahead. Understand this. First, assessment under section 143.3. It is under reporting of income. Same thing you will have. Under reporting of income would be equal to assessed income minus 143.1. Assessed income minus 143.1. So which would be 62 lakhs minus 62 lakhs minus 45 lakhs. 62 lakhs minus 45 lakhs gives you 17 lakhs. Gives you 17 lakhs. Same manner again you have to compute tax on underreported income plus previous order minus tax on previous order. Tax on previous order. So tax on underreporting of income plus previous order minus tax as per the previous order. Underreporting of income is 17 lakhs. So it will be tax on 17 lakhs plus 45 lakhs. 17 lakhs plus 45 lakhs. It will be 17 lakhs plus 45 lakhs, which will be on 62 lakhs multiply by 30 percentage multiply by 1.04. That is cess. That is cess. So we'll have 19 lakh 34,400. 19 lakh 34,400. From this you will reduce tax as per previous order. Previous order we have got 45 lakhs. So it would be 45 lakhs multiplied by 30 percentage multiplied by 1.04. 45 lakhs multiplied by 30 percentage multiplied by 1.04, which will give you 14 lakh 4,000 rupees. 14 lakh 4,000 rupees. Tax on underreporting of income would be 19 lakh 34,000 minus 14 lakh 4,000. You will have 5 lakh 30,400. You will have 5 lakh 30,400. Right? Then we have to then next this is a case of under reporting, so penalty would be 5,30,400 divided by 2, which would be 265,200. 2,65,200. Right? Moving on to the next one, assessment under section 147. Assessment under section 147. Under reporting would be equal to same like what we discussed, reassessed income minus assessed income. Reassessed income we have got 81 lakhs. So it would be 81 lakhs minus the assessed income. Assessed income is 62 lakhs. So you will have 19 lakhs as under reporting of income. You will have 19 lakhs as under reporting of income. Tax on under reporting of income, same manner, plus previous order minus tax on previous order. Tax on previous order. Under reporting of income is 19 lakhs. Previous order income is 62 lakhs. So tax on 81 lakhs should be found out. So it will be 81 lakhs multiplied by 30 percentage multiply by 1.04. That is cess. That is cess. So we will have 25 lakh 27,200. 25 lakh 27,200 plus tax as per previous order. Previous order tax is 19 lakh 34,400. So tax on underreporting of income would be 25 lakh 27,200 minus 19 lakh 34,400 minus 19 lakh 34,400. So you will end up having 5 lakh 92,800. 5 lakh 92,800. Penalty would be 5 lakh 92,800 divided by 2. 50 percentage would be penalty, which would be 2 lakh 96,400. This is for alpha. Let's go ahead. Understand for beta. Understand for beta. Beta, the turnover is 401 crores. Let's go ahead. Computation of this will call as penalty for alpha limited. Now, penalty for beta limited. Turnover more than 400 crores. Rate of tax would be 30 percentage. Rate of tax would be 30 percentage. But this is the case of loss return. So we have to accordingly do that loss. First, under reporting of income. Under reporting of income will be equal to loss as per loss return of income is filed. So loss as per assessed income minus loss as per 143.1. So under reporting of income would be equal to 2 lakhs minus 6 lakhs, which would be 4 lakhs. Loss would be 4 lakhs. Tax on under reporting of income. That's all. That is 4 lakhs into 30 percentage into 1.04. That's all. Straight. You will not go ahead and take up the previous order. Nothing. It will be tax on under reporting of income. Will be tax on under reporting. Find out the tax. Multiply by 30 percentage into 1.04. Penalty would be 50 percentage of this. Penalty would be 50 percentage of 1,24,800. 62,400 would be the penalty. This is in case of assessment under section 143. Assessment under section 143. Now, assessment under section 147. So again, it would be, please understand, assessment under section 147 has become a income. So it is total income, which is 6 lakhs. Then loss as per previous order 2 lakhs. So under reporting of income would be adding both. You have to from 6 lakhs of from 2 lakhs of loss, it has got to 6 lakhs of income. So 8 lakhs would be the additions. Under reporting, tax on under reporting would be 8 lakhs into 30 percentage into 1.04. 8 lakhs into 30 percentage into 1.04. Right. Now, penalty would be equal to 2,49,600 divided by 2 gives you 1,24,800. 1,24,800. Hope you are able to understand this. In case you have got doubts, we will discuss. Otherwise, let's move on to understand uh, um, exclusions from underreporting of income. The following will not be considered as underreporting of income. Exclusions from underreporting of income. Right. Let's go ahead. Understand the exclusions from underreporting of income. Hope you don't have any doubts until this point of time. Let's go ahead. Circumstances in which assessing officer assessing officer cannot levy penalty. First one, if for the underreporting of income, if for the underreporting of income, the assessee explains or gives a proper explanation to the assessing officer or to CITA. Proper explanation is shared by the assessing officer. The proper explanation is shared by the assessee to the assessing officer or to the commissioner of income tax appeals. In that case, there cannot be any underreporting of income. Let's say you genuinely believed that TDS is not liable to deduct. You have also got an opinion from a chartered accountant or from an advocate, and they also believed. But subsequently, the High Court gave a judgment against the assessee. Therefore, it is I give an explanation. See, I have taken all sorts of necessary precautions before I took this decision. So, offers proper explanation. Second, underreporting of income is on account of search operations, income tax rate, because there is a separate penalty for this. We are going to discuss when we talk about search and seizure. If it is in relation to search proceedings, then underreporting of income is based on an estimate. It is based on an estimate. Next, The underreporting of income is on account of transfer pricing adjustment. Transfer pricing adjustment, provided all the necessary documents are maintained by the assessee as required in 92D, section 92D, as required in section 92D, proper documentations have been maintained. Proper documentation is maintained for a transfer pricing adjustment, then penalty cannot be levied. Penalty cannot be levied. So in four circumstances, 270A penalty cannot be levied. First, the underreporting of income, the assessee offers proper explanation. The assessee offers proper explanation to the assessing officer. Proper explanation is given to the assessing officer. Then you cannot levy penalty. Second, it is based the assessing, the underreporting is on account of search operations. Is on account of search operations. Then again, penalty cannot be levied. Third, the underreporting of income is based on an estimate. Is based on an estimate. Then it cannot be levied. The fourth and the final one would be for a transfer pricing adjustment. You cannot have an underreporting if proper documentation have been maintained by the assessee. Proper documentation is maintained, then underreporting of income is not possible.
So do we mean raid when we say search operation?
Search operations, yeah.
So then why don't we have this penalty, sir? Do we have any other penalty in
Separate
such?
penalty we have got. Yeah.
Oh, okay, okay.
It's a bigger penalty that we have got.
Yeah, okay, sir, understood.
So let's quickly go ahead and read the entire 270A that we were discussing until this point. In the course of assessment or reassessment proceedings, if the assessing officer is satisfied that the assessee has underreported or misreported his income, then the assessing officer may direct the assessee to pay the penalty. Similarly, in the course of appellate or revisionary proceedings, CITA or CIT can direct case of underreporting of income. First, return of income is furnished, assessment is made for the first time. Underreporting would be equal to assessed income minus income as per 143.1. Assessed income minus income as per 143.1. Return of income is not furnished and assessment is completed under section 144. Return of income not furnished and assessment can be only under 144. Underreporting of income would be income assessed minus basic exemption. For someone, if basic exemption is not there, then it is zero. That's all. Case 3, income reassessed. Underreporting of income would be equal to income reassessed minus income assessed in the preceding order. Take the preceding order, whatever we have got. Return of income is furnished and assessment under section 115 JB or JC is applicable. Underreporting of income would be additions under normal provisions plus additions under book profit or adjusted total income rule. That is MAT or adjusted total income is AMT. Loss written under reporting of income would be loss assessed minus income or income assessed. Loss assessed or income assessed. Sometimes the loss could have converted into income minus loss as per the return of income. Computation of tax on under reporting of income. No return of income is filed and the income is assessed for the first time, then tax on under reporting of income would be equal to under reporting of income you have found out. Now on that we have to find out the taxes. Tax on under reported income plus basic exemption. In case of loss, tax on under reporting of income will be equal to tax on under reported income. Just under reported income you will take. In any other case, it will be tax on underreported income plus income as per the previous order minus tax as per the previous order. Cases of misreporting of income, suppression of facts, failure to record investment in the books of accounts. You are not recorded the investment in the books of accounts. Expenditure is not sustained, substantiated by any evidence. A recording of any false entry in the books of accounts. Books of accounts, you are not passing the correct entry. It's a false entry that you are doing now. Failure to record any receipt in the books of accounts having a bearing on the total income. On the total income, failure to report any international or specified domestic transaction. Quantum of penalty, misreporting the 200% of the tax on underreporting. For others, that is 50%. So you found out tax on underreporting, misreporting, na it will be multiplied by 2, others na divided by 2. Exclusions. The amount of income on which assessee offers proper explanation to the assessing officer. The amount of underreporting of income is based on an estimate. The amount of underreported income is determined by transfer pricing officer. However, proper books of accounts have been maintained as reported in 92D. The amount of undisclosed income on account of search operations. Separate penalty is applicable. This I missed. Yeah. Now, let's say there is any source of receipt or investment in the current year. It is claimed to be. I'll just take up this, explain, then we'll read. There is a receipt. We'll take an example of receipt applicable for the same thing. It is claimed to be a amount added to the income of any earlier year. Then no penalty was levied in the earlier year. In such earlier year, penalty was not levied. Such income would be included as underreported income in the current year. It would be reported as underreporting of income. Section 270. All that we discussed now are all in section 270A. Now, so here is the case whereby the assessee in the earlier year, the assessee has in the earlier year there was no. Just give me a minute, folks. So here there was a case where there was a receipt or deposit appearing in the current year, which is claimed to be the amount added in the earlier year. No penalty was levied in the earlier year. Then the penalty would be levied in the current year as an underreporting of income. Methodology and all, it remains same. Methodology and all remains same. So this is what we have got for section 270A. In case you have got doubts, we will discuss. Now there are quite a few other penalties that we have got, which we have already discussed at appropriate places. For example, section 271A, penalty for non-maintaining the books of accounts. We'll have 25,000 rupees. Section 271B, penalty for not carrying on tax audit. We discussed the appropriate times. In our last lecture, we talked about 271 DA, DB, that is, if at all you have got a penalty where you did not follow 269 SS, 269 SP, all those penalties we discussed at appropriate times. Similarly, section 9A, when we talked about section 9A, fund manager, there we saw penalty under section 271 FAB. We discussed all those things. So there are appropriate places where we have discussed penalties. So those penalties would be in addition to this. This is a separate penalty which is for underreporting or misreporting of income.